The Indian ethnic wear market is a 1.6 lakh crore rupee industry, driven by one largely recession-proof event, the big fat Indian wedding. Sai Silks used IPO proceeds to clean their balance sheet, collapsing debt from 405 down to 20 crore rupees. Cash generation stands out too. Operating cash flow hit 323 crore, a massive liquidity buffer vastly outpacing reported net profit. Yet foreign institutional investors are exiting, with holdings collapsing from 3.5% down to roughly 0.5%. And the headline 133% net profit jump hides an accounting trick. Due to a previous high tax base, real pre-tax profit growth was actually a smaller 12%. That institutional exit is driven by a stalling operational engine. Revenue growth slowed to just 5% in the latest quarter, and same-store sales growth is stuck at an anemic 3%. They have a bulletproof balance sheet, but investors aren't seeing the organic growth. To understand why their legacy stores are slowing down, you have to look at how they actually source their products. They operate a hyper-localized, direct-to-weaver supply chain. By integrating a network of over 4,000 master weavers, they bypass the middlemen entirely. That direct procurement gives them exclusive access to traditional designs at scale and preserves 15 to 20% of their profit margins. This visualization weighs their incoming cash flow against the massive block of capital locked up in their warehouses. Right now, Sai Silks is sitting on 816 crore rupees worth of silk stocks, creating an inventory cycle that lasts 323 days. For a standard retailer, tying up that much capital for almost a year would be fatal. But wedding shopping is a high-touch family experience. The customer expects an overwhelming variety of colors, fabrics, and patterns under one single roof. National giants are trying to enter the sari space using standardized corporate operating procedures. Sai Silks fights back by offering that deep, localized variety that builds generational trust with local shoppers. That massive mountain of inventory is a dual-edged sword. It locks up their capital, but it builds the specific, auntie-approved trust necessary to defend their regional dominance in the South. The company is now transitioning its leadership, putting the managing director's son-in-law in the CEO seat with a specific mandate: push EBITDA margins up to 18%. To hit those numbers, they are aggressively expanding their premium Vara Mahalakshmi format. This higher-margin brand has evolved into their primary engine, now bringing in 52% of total sales. It works because the sales density of these premium stores is elite. They generate revenue per square foot that rivals premium jewelry showrooms, structurally high-grading their entire profit and loss statement. But they have largely saturated their home turf. To achieve the kind of double-digit growth that will bring institutional money back, they have to take this successful cluster-based model and test it outside of South India. Their target for this next phase of expansion is Maharashtra. They are taking their premium formats into the high-spending but notoriously expensive urban markets of Mumbai and Pune. Taking a heavy inventory model and dropping it into high-rent Western markets is a massive risk. It's the ultimate test to see if their regional moat is actually portable. Fortunately for the new CEO, the calendar is on their side. The upcoming fiscal year boasts a 10% increase in auspicious Hindu wedding dates, providing a powerful cyclical tailwind for consumer spending. They are going to need every one of those sales, because corporate conglomerates with deep pockets are aggressively scaling into the ethnic wear sector. Specifically, Tata's Tenera brand and Reliance's Avantra are directly targeting those South Indian strongholds, trying to siphon off the premium wedding shopper. Sai Silks isn't backing down. They're planning a 20% footprint expansion, adding 100,000 square feet of new retail space, and funding the entire build-out internally without taking on a single rupee of new debt. The success of this rollout faces two major threats. The high rents in Mumbai could easily eat into their initial margins, and their 300-day inventory cycle becomes a massive liability if local fashion trends in these new Western markets shift unexpectedly. Sai Silks has managed to build a cash-rich, debt-free regional fortress, but their valuation on the stock market now hinges entirely on whether they can hold off the corporate giants at home while scaling their South Indian magic into a national empire.